The year is 2024. Stock markets in the United States are surging to new heights. Every day brings another record. Cryptocurrencies command headlines and capture imaginations. Bitcoin, Ethereum, and new tokens have gone mainstream, yet a spectre haunts this revelry doubt. Is this market ascent sustainable growth or a dangerous bubble? This is not merely an academic question. The spectre of 2000 lingers. The dot-com bubble burst led to trillions in losses. Are we on the precipice of another collapse, or is this time different? To understand the present, we must turn to the past. History, particularly financial history, has a way of repeating itself. The current market exuberance bears striking similarities to previous booms, most notably the dot-com bubble of the late 1990s and the roaring 20s leading up to the Great Depression. In both cases, investors poured money into assets perceived as revolutionary and transformative. In the 1920s, it was radio and automobiles. In the 1990s, it was the internet. Today, it is a confluence of factors: artificial intelligence, blockchain technology, renewable energy. The parallels are undeniable, yet there are also crucial differences. The global economy is more interconnected than ever before. Central banks have adopted new monetary policy tools, and the rise of retail investing, fueled by social media and trading apps, has injected a new level of complexity and unpredictability into the market. To comprehend the current market surge, we must dissect the forces propelling it. One key driver is investor sentiment. Confidence in the economy, fueled by low interest rates and government stimulus measures, has reached unprecedented levels. This optimism has unleashed a torrent of capital into financial markets. Individuals flush with cash and emboldened by a fear of missing out, FOMO, have become a driving force. However, investor sentiment is a fickle mistress. It can shift quickly, driven by news events, geopolitical tensions, or simply a change in the prevailing market narrative. As John Maynard Keynes famously remarked, the market can stay irrational longer than you can stay solvent. The current bull market has been remarkably resilient, but its foundation, built on confidence and abundant liquidity, is inherently unstable. The siren song of valuation. The allure of quick riches often drowns out the voice of caution. Yet, even amidst the euphoria, warning signs abound. Valuations across many asset classes have reached levels not seen in decades. The cyclically adjusted price-to-earnings, or CAPE ratio, a measure of market valuation, stands well above its historical average. Bond yields, typically an indicator of risk appetite, remain stubbornly low. This disconnect between market valuations and underlying economic fundamentals suggests that investors may be pricing in unrealistic expectations of future growth. The market, as it often does, may be getting ahead of itself. This does not necessarily mean a crash is imminent. Markets can remain overvalued for extended periods. However, it does suggest that a correction, when it inevitably arrives, could be swift and severe. Beyond the traditional cryptos dance with destiny. No discussion of the current market landscape would be complete without addressing the elephant in the room: cryptocurrencies. Bitcoin, Ethereum, and a plethora of other digital assets have witnessed astonishing gains, minting millionaires and capturing the imagination of a new generation of investors. Cryptocurrencies represent both a challenge and an opportunity. They challenge the traditional financial system, offering an alternative to fiat currencies and centralized institutions. They also present an opportunity for investors seeking high returns and exposure to a new asset class. However, the cryptocurrency market remains highly volatile and largely unregulated. Its future, while potentially transformative, is shrouded in uncertainty. Charting a course through uncertain waters. We stand at a crossroads. The global economy is awash in liquidity. Technological innovation is reshaping industries. Investor optimism has propelled markets to dizzying heights. Yet beneath the surface lies unease. Valuations are stretched. the spectre of past bubbles looms large. The long-term impact of monetary policies remains unknown. Navigating these waters requires prudence and discipline. Investors should heed history, diversify, and temper expectations. The future remains uncertain.